What is up? This is the Working Investor. In this video, we're going to talk about a product or series of products that's paying 100+% dividend distribution. Talking about the one, the only, this series of YieldBOOST from GraniteShares. Is this too good to be true and just fool's gold? Are we just tripping over stacks of bills to pick up some pennies? Or is this really a force to be reckoned with? We are going to go under the hood and look at the strategy, and we're going to go over the strengths and weaknesses of the strategy, and we are going to backtest it against other funds and the underlyings to see how they have performed in the real world. As always, nothing here is financial, tax, legal advice, exercise advice. This is all purely for fun and entertainment purposes only. Please see all my disclaimers. Let's get into the video. So they have a lot of products in their product line of the YieldBOOST products. It's a lot to cover in one video. We're going to go over the TSYY from Tesla. We're also going to go over the basket, fourth from the bottom, TQQY. So this is a triple leverage product. And for fun, we'll go over their Nvidia product as well. And if we have time, we may go over XBIT from their Bitcoin product. First, let's understand how these funds are constructed, and then let's look at its strengths and weaknesses. So the construction, what I understand, and we're going to look at the website, and I would advise you to look at the website and their prospectus. It's a put credit spread. It's a put credit spread on assets that arguably already have a lot of volatility in the underlying. Now, this is the key over here. There is no long position. It could be good or it could be bad. And we're going to go ahead and backtest and see what the case is. And it has 2x. They don't own the underlying, but they trade the put credit spread on 2x and 3x products. Now, if you don't know what a put credit spread is, I'm going to show you a little bit, to give you a little introduction what it is, because it's paramount to understand this strategy. And finally, we'll talk about the performance. So a put credit, and we won't go into too much detail, but just enough to cover a little bit of an overview, consists of two pieces. There is a short put. That means you sold a put. When you sell something, you make money, so you get a credit. And then on the end of it, where you see the dotted lines, they bought a put. And when you buy something, you pay money. So it's called a credit spread because the money that you receive from selling the short put is greater than the money you pay to buy the long put. Now, we won't get into too many details what a put is because that's going to take a lot of time and I don't want this video to drag out. But the point is key. Let's say the market is down 3%. If you own the underlying, you would be down 3%. You know, if the underlying is a leveraged fund and the leveraged fund is down 2 times 3%, 6%, then you're down 6%, right? Now, this is key. How wide is the spread? That is very key because that tells you your maximum loss. So the pro is you receive a credit. So you're making income because they're creating a credit spread. But let's say, for example, it's a 2% wide spread. So let's say it's $100 underlying and 2% of that is $2. So the difference between the short put and long put is $2. So if you pay attention to the red arrow, you're going to, every time they do a credit spread trade, I think they do it weekly, what I understand. Every week you're going to make that credit. You're going to make some credit. You're going to make some credit. It's not going to be 2%. It's going to be possibly 1% or 0.5%, whatever it is, you're going to make some credit. It's all good until the red arrow blows through the spread. And if it's a 2% wide spread, then your maximum loss will be the 2%, in this case, $2. And let's say every time they sell a put credit spread, let's say they make 50 cents. So let's say for 1 month straight, they received 50 cents, for 4 weeks in a row. So now you've received $2. And then finally, bam, the market blows through that spread. The maximum loss is $2 because that's the width of the spread. So now all the credit that you've received, you've lost price appreciation equal to that income. And now you're back to zero. I used to run put credit spreads, call credit spreads, iron condors for about a year, maybe longer. So I'm very familiar with this type of strategy. My bread and butter for a long time. So they call it the freight train approach. It's like you're picking up dollars on the tracks and nothing is going on. And every day you're going and picking up dollars. But you're totally fine until you're not. One time the freight train hits you, all that money is gone. It's not worth it. So like you saw, one loss could outpace 4 wins in the example that I gave you. It's not always that's just an example. Some people call it like the steamroller or the cement roller, and you're picking up pennies in front of a steamroller. And if you're all good as long as you don't get crushed. Let's go back to the strategy. So now you understand put credit spread. Now, what is the probability of you getting crushed? So it depends how far away from the money they write the strikes, okay? And we're going to go ahead and look and backtest to see how they did. It also, the more volatile the asset, the more likely it'll blow through. Because things that are less volatile, I would think, would less likely blow through the spread. But now, if you take something that's already volatile and you add 2x leverage, it's not volatile enough. Let's add 2 times the leverage. And some of the products have 3x leverage, 3 times the leverage. I'm going to ask you, what do you think the chances are that it's going to blow through the spread, right? Now, the good thing is it's a defined risk trade. Because they have a spread, the most you could lose in any trade is the width of the spread. So if it wouldn't be a spread, you would have a lot more undefined loss. So at least it's a defined risk trade. I give them credit for that. Now let's look at, there's no long position. Is it good or is it bad? So it's bad when the market is going down, because let's go back to the example. Let's say the market is down 3% and the put spread is 2% wide. So if they had a long position, in addition to the long position, they had a put credit spread of 2% wide is the width of the spread, then you would lose 3% what the market delivered. So the market delivered a negative 3% for the week. Your assets will be down 3% for the week. In addition to the 3% you'd be down for the week, you'd also be down additional 2% because it blew through the spread. So the underlying is down 3%, you're down 5%, but you have to add that little bit of credit back. So let's say you got that 50-cent credit, so you're only down 1.5% extra in addition. So if the market's down 3%, you're down 4.5%. I hope you are with me on this. So that's the good part if they don't hold the underlying when the market is trending down, because you don't amplify your losses beyond the blowout of the spread. But what's the bad? The bad is that when the market goes up, you don't have any price appreciation. Your only source of creating wealth, aka total return, is the credit spread. There is no growth. You know how in a cover call strategy, people are always worried about capped upside? Because in a cover call, you get all the downside risk, but you get capped on the upside. Well, here you would get no upside, zero upside. Forget capped upside, no upside. But you don't look at the red arrow very carefully. Even if the market goes down, as long as it doesn't hit through the put spread, you don't feel the hit. So you don't get all the ride down. You get some of the ride down. But once it, depends how close to the money they write the spread. So with a cover call, you get all the losses and some of the upside. Here you get no upside and you get some of the losses. So it's a little bit of a different strategy. So let's go ahead and look at TSYY on the website. You could see, we'll focus on a few things. Number one, it's cool. Yeah, they pay weekly. They pay a high distribution where they're advertising 147.93%. They do have a 99 basis points management fee. And then they have, I think they say here, a net annual operating expense of 107 basis points. And focus on the date because we're gonna back test this for the time they were launched from December 18, 2024. Let's take a peek at the holdings so you see what I'm talking about. So you see that they're trading TSLL. Let's look at the price of TSLL. This is according to stock analysis. It's $19.84. I pulled up the holdings from the website, and this is the Excel spreadsheet that I have from TSYY. You see they have positions from today, and you could see here, it looks like they have a bunch of puts on TSLL, and you could see here that they have 11,630 contracts of, and a negative means a short, they sold on the $19.89 put. So look, it's trading at $19.84. So it already blew through the short put. And after hours, it's $19.77. So from 1989, it went to 1977 after hours. But their long put, they have the same amount of contracts, 11,630 contracts. It's a 1750 put. So they're within the range. And then they kind of stagger it. They have a 19, you see here, negative 510, positive 510, negative 5,900, positive 5,900. So, and the bottom, they have a negative 18,300, 183,480, and then against the other amount. So you see they have basically three different layers of put spreads. It looks like they're all expiring October 17, 2025. And they have some treasury bills. But what are they missing? There's no long position. It's just put spreads like they say on the website. And you can see their TSYY is designed to generate income through option strategies, primarily by selling put options on leverage ETFs that track 2x long Tesla daily ETFs. So it's reset daily, so there is something called volatility, decay, and path dependency also. So I'm going to go ahead and back test from 12/18/2024 from the time they launched, and we're going to compare it to three other ones. We're going to compare it to Tesla. That's going to be the benchmark because that's the underlier. We're also going to compare it to Tesla from YieldMax, and we'll test it. We'll also back test it to TSLP from Curve. Why am I choosing these? Because they have been around the same time. I want to get the longest timeline. So I should probably add TSLL as well. So let's go ahead and analyze this back test. So in this period of time, from December of 24 till October of 25, so approximately 10 months, Tesla is down 2. I got to change it to total return, guys. Okay, so Tesla's down, it's the middle one, 2.47%. So that's the benchmark. TSYY, which is leverage Tesla, 2x leverage Tesla. I'm sorry, TSLL. Oh my God, guys, TSLL. 2x leverage Tesla is down, not 2%, not 4%, 41 whopping percent. Almost down 20 times greater than Tesla. What does that mean? That's something called path dependency, volatility decay, that just because it's a 2x leverage fund, it's reset daily. So the losses are compounded. Because if this was reset yearly, you would be down 4%, 4 or 5%, not almost 20x, 18x to 20x. So now TSYY, with this strategy, they're down almost 13%. So they did a lot better than TSLL, but they did a lot worse than Tesla. But then you could look at Tesla and TSLP. You're going to tell me, oh, this is a total different strategy. They're synthetic cover calls. Yes, but that strategy is on the same underlying, it's a different strategy. They're not using leverage, and they're synthetic, and and their strategy is doing better. Their curve actually delivered a positive return from a negative product of 0.44%. Everything is relative to the underlier, in my opinion. Let's go ahead and compare their NASDAQ, their TQQY, which trades put spreads on TQQ. And we're going to start it from 2/26/2025. It looks like that's when they started trading according to Seeking Alpha. So now that we have the precise dates in, let's see the results. So in this period of time, TQQQ, triple leverage NASDAQ, triple leverage Qs, delivered a little more than 30% total return. There's no dividends, but that's the total return. The Qs, which is regular, non-leverage, just regular Qs, 16.65%. GPIQ, which is from Goldman Sachs Cover Call ETF. QQQI from Neos Cover Call ETF. Both of them are on the Qs. They delivered just under the Qs, which I would expect from a Cover Call ETF. 13.93 and 13.34%. Look at TQQY from GraniteShares. Negative 0.2%. When you could have just been in the Qs and gotten 16%, you would have been 80 times better total return just for being in the Qs. Or you could have had income and been in GPIQ and done way better than TQQY. And TQQQ is like astronomically higher than TQQY. So I understand on the website of GraniteShares, TQQY advertise a distribution rate of 51.69%, and their frequency of payment is weekly, and they're knocking out these dividends every single week. It looks like ordinary income, 18 cents, 18 cents, 17 cents. But you know what? You could take all those dividends, in my opinion, and just throw it out the window, because I'd rather just be in the Qs or GPIQ, QQQI if I want to have income and do infinitely better. Those 18 cents is like tripping over dollars to pick up 18 pennies every week. Let's go ahead and look at XBITI. This is a very famous one. The Bitcoin 2x leverage long daily reset, put credit spreads, and they're giving a distribution rate of 110.22%. My God. Paying weekly, and they're paying 36 cents on the last distribution amount per the website. I just pulled up their holdings on their website. So their XBITI fund looks like they have some US treasuries. I guess they use it as collateral. And I see here a put credit spread on BITX expiring on the 17th of October. And you can see it's a spread because you see 10,320 shares negative. That's a sell. And then you bought 10,300. I'm sorry, I meant to say contracts on the BITX. So we'll go ahead and backtest it per the website that came out May 12th, 2025. I'm showing you this because I want to show you that I'm not cherry picking the dates. I'm trying to give you the biggest backtest possible. We'll go ahead and compare the famous XBITI to BTC US dollar, to BITX, which is the underlier that XBITI trades on, and then just a simple cover call strategy of YBTC. I think it's from Roundhill. So you could see in this period of time, I had to do the total return. So I'll show you again. May 12th, 2025, this period of time, total return, XBITI, total return, down 3.62% total return. Bitcoin in this period of time delivered 6.43% growth. BITX, which is the underlier that XBITI does its put credit spreads, is up 8.88%. That means it blew through the put spreads. That's my only understanding why it's down. And then YBTC, a simple covered call ETF from Roundhill, 8.74%, outperforming Bitcoin. And it doesn't even do it on 2x leverage Bitcoin, and it's outperforming Bitcoin, almost performing as much as a 2x leverage product. I don't want to insult anybody. I know a lot of people are very passionate about these funds. And I'm not trying to make you feel stupid. I want to explain to you the strategy and why I do not like it, because now we have the luxury of back testing these strategies. I want to give a shout out to Yujin because I'm part of his Discord. I have my own Discord, and I'll put my link, but I'll put a link to his YouTube channel because he has a very smart group in his Discord. And some people are really creative in how they strategize with these funds. And I met somebody in his Discord that we were going back and forth about XBIDI, and I heard this incredible strategy where he's doing something called a covered strangle, and that's a whole different topic. And I've done covered strangles in the past, and I thought it was kind of brilliant that he does that. So I just like to surround myself with smart people that think out of the box. So just a shout out to Yujin and very smart people in his Discord. Again, nothing here is financial advice, just a bunch of people just bouncing ideas off each other. You need to do your own homework. Now, I just wanted to show you that I'm fair. One of their funds I found that may have done a little better was their Nvidia product, NVYY. And per their website, they pay 101.48% distribution rate. I guess maybe it's from the last one. I don't know. That's what they advertise on the website. Weekly payments. But look, they came out May 12th, 2025. So let's go ahead and back test this product. So we're looking from May 12th, 2025 to today. And we're looking at NVYY. I'm comparing it to Nvidia, which is the underlying. Well, actually, that's not the actual underlying. Hold on. Because it trades NVDL. So let me put NVDL in there. Okay, we got everything in there. Total return. Let's see. Let's see the results. So in this time frame, NVDL 2x leverage, I think it's from GraniteShares. It's their 2x leverage product. Delivered 96.12%. Nvidia, which is everything is based off Nvidia, 46.38%. So this is something that the stock was trending in the right direction, trending up. When you're working with leverage, and if it's trending in your favor, you could really compound your gains. But when it's trading against you, you could compound your losses. So look at NVDY. This is the YieldMax cover call ETF from Nvidia. 37.66%, which is actually pretty good because I feel like a good cover call strategy, I say it in my video, in my opinion, not financial advice, tracks about 75 to 80% is an excellent cover call tracking because you won't expect a cover call to outperform in all market conditions, especially when it's trending up. So I think it did a decent job tracking, in my opinion. But look at NVYY, still not terrible. You're positive 30.23%. But relative to Nvidia, it's lagging. And relative to the cover call strategy, it's lagging. Relative to the 2x leverage products, it's lagging. Perhaps if the GraniteShares had some of the underlying, maybe, let's say if they had the underlying of Nvidia, not even the 2x leverage, let's say it tracks the regular underlying and maybe does maybe does their put spreads on the 2x leverage portion or on the regular portion, maybe they wouldn't do so bad because they would at least get that growth as well, uncapped upside with, defined risk on the downside, kind of like a lightning spread. That's just how I would do it, but I'm not a financial advisor. It just is my personal opinion, not financial advice. But you could see that it's a positive return, but it's not that 101%. It's like a bait and switch, not really saying it's bait and switch, but don't think you're going to get 101% when you see the 101%. The total return since May, it's not a year yet, is 30%, and relative to the underlying, it's lacking a little bit. I hope I did not offend anybody by any means. I just want to show you my analysis, what I'm seeing. A lot of people have creative ways of working it, but you have to ask yourself, if you're so good in working a strategy, how good would you be if you're working a strategy that's working even better? But I am not going to tell you to invest in anything I'm not allowed to, and that is completely up to you. You make your own decisions. Different products work for different people. different products may work in different circumstances. So there's a product for everybody out there. Take it or leave it. This is my analysis. Let me know if you have a different analysis or if you found anything that I said incorrect. And I'm here to learn just like everybody else. This is the Working Investor over and out. I hope you guys have a wonderful trading week. Be well.